Are you struggling with credit card debt? It's a common issue that many people face, but the impact it has on your life can be far-reaching. Let's talk about the negative effects of credit card debt. First, there are the growing interest charges. Like a snowball rolling down a hill, this debt can grow larger and faster, making it increasingly difficult to pay off. Then, there's the potential damage to your credit score. This three-digit number can determine a lot in your life, from getting a loan to renting an apartment. If your credit card debt is high, your score could take a hit. Furthermore, credit card debt can impact your overall financial health, leaving you feeling stressed and overwhelmed. However, it's not all doom and gloom. But don't worry, there are strategies to help you conquer your credit card debt. The first step in tackling credit card debt is understanding your spending habits. It's all about getting a clear picture of where your money is going. Are you spending excessively on dining out or online shopping? Or perhaps it's those monthly subscriptions that are silently draining your wallet? Analyzing your spending habits is essential, not to make you feel guilty about your purchases, but to help you identify areas where you can cut back. It's about making changes that can reduce your expenses, helping you free up more money to put towards your debt. As you start to rein in your spending, you'll notice a decrease in your overall balance, and this, in turn, will limit the amount of interest you're charged. Interest can accumulate quickly on credit card debt, so reducing the balance is key to slowing down this growth. Think of it as a snowball effect. The more you cut back on unnecessary spending, the more money you can put towards your debt, and the faster you'll see that debt decrease. It's a positive cycle of financial health and freedom. Remember, every little bit of saving counts when it comes to paying off your debt. Paying the minimum on your credit card bill might seem like a good idea, but it's actually prolonging your debt. Here's why. Every time you make a payment, it's divided between the interest accrued and the principal balance. If you're only paying the minimum, a significant portion of your payment is going towards interest, not the actual debt. So, what's the solution? Paying more than the minimum. This approach allows you to chip away at the principal balance faster, reducing the amount of interest that accumulates over time. It's like trimming a tree. The more branches you remove now, the less there will be to deal with later. Imagine this. Your credit card debt is a mountain, and your payments are steps. The minimum payment is a small step that doesn't get you very far. But if you take larger strides, you'll reach the summit sooner. And the view from the top? That's financial freedom. Remember, your credit card company is in the business of making money. The longer you're in debt, the more interest they collect. Don't let your hard-earned cash line their pockets. Think of it as a race against interest. The faster you pay, the less interest you'll accrue. If you're overwhelmed by multiple credit card debts, consolidation might be a viable option for you. Debt consolidation involves combining all your credit card debts into one, ideally with a lower interest rate. This not only simplifies your payments, but can also save you money over time. One method of consolidation is using a balance transfer credit card. These cards often offer a promotional period of zero interest, allowing you to pay down your debt without accruing additional charges. However, it's crucial to pay off the balance before this period ends, as the interest rates can skyrocket afterwards. Another option is a debt consolidation loan. These are personal loans that you use to pay off your credit card balances. The advantage here is that these loans often offer lower interest rates than credit cards. Companies like SoFi, Happy Money, and Lending Club are often mentioned as top personal loan lenders for credit card consolidation. But remember, qualifying factors include your credit score, income, and credit history. There are potential drawbacks to consider. Fees and shorter repayment terms can increase your monthly payments. Plus, a hard credit check might be required, which could impact your credit score. Remember, consolidation is not a magic fix, but it can be a tool to help manage your debt. Having a plan to pay off your debt is crucial for success. Let's talk about two popular strategies: the debt avalanche and the debt snowball methods. Picture yourself standing on a mountain. The debt avalanche method is just like this. You start with the highest interest rate debt and work your way down. This method may save you the most money over time because you're tackling the most costly debts first. On the other hand, the debt snowball method starts with the smallest debt, regardless of interest rate. Once it's paid off, you roll that payment into the next smallest debt. It's like a snowball rolling down a hill, gaining momentum as it goes. Both methods have their merits, and it's important to choose the one that best suits your financial situation and mindset. The key is to stick to your chosen plan consistently. Remember, Consistency is what turns small wins into major victories. A well-structured debt payoff plan can be your roadmap to financial freedom. It helps you stay focused, organized, and motivated. It's not just about getting out of debt, but also about building a healthier financial future. With a plan in place and a commitment to follow through, you can conquer your credit card debt and reclaim your financial health.